Okay, picture this. You log into your ITR portal, getting ready to file, and boom, your entire tax calculation is completely flipped upside down, and you didn't even click a single button. Yeah, the Income Tax Act 2025 has literally rewritten the playbook for your next filing. So in today's explainer, we're going to dive straight into this massive default regime shift and what it actually means for your wallet. So here's the deal. For the very first time, starting in 2026, when you log into that portal, the new tax regime, which is now officially sitting under Section 202 of the 2025 Act, is going to be auto-selected for you. It is the new default. The old clunky previous year and assessment year framework, that's completely gone. We are talking about a unified tax year now. And under this new timeline for tax year 2026-27, the government is basically making the choice for you. If you don't actively say no thanks, you're automatically enrolled. And honestly, this automatic switch, it's catching a ton of taxpayers totally off guard, especially our non-resident Indians and expats. I mean, they're logging in and suddenly finding their entire tax liabilities recalculated. For NRIs, this is actually a double whammy because the residency rules have these new look-back periods too. If you're sitting in Dubai, Singapore, or London right now, expecting those same old trusty deductions, well, consider this your major wake-up call. Now, to be fair, they are offering a pretty huge sweetener to keep you in this new default system. Just look at these progressive slabs. You get a really attractive 4 lakhs rupee tax-free base right off the bat. From there, the rate is just 5% between 4 lakhs and 8 lakhs. And it climbs super gradually, meaning you only hit that top 30% bracket when your income actually crosses 24 lakhs rupees. Oh, and they bumped up the standard deduction to 75,000 rupees. So, on the surface, it sounds like an absolute steal. But wait. Here is the severe trade-off for those lower rates, and I'm going to give it to you rapid fire if you stick with this auto-selected regime. Your beloved ADC investments, which the new act calls Section 123, gone. Your ADD health premiums, now Section 126, gone. And that massive home loan interest deduction for your house, completely wiped out. House rent allowance, gone too. This new regime literally strips away almost every single major tool you've historically used to shrink your taxable income. Right, so naturally, you're probably thinking, okay, I'll just switch back to the old regime. Well, if you run a business or you have professional income, say you're a freelancer or a consultant, you are walking into a strict compliance trap. You cannot just click a button on the portal. You absolutely must file a specific declaration called Form 10 IEA before the due date to officially opt out. And here is the real kicker. If you ever decide to withdraw from the old regime and go back to the new one later, it is an irrevocable, once-in-a-lifetime decision. No going back. This whole setup just brilliantly highlights the huge divide right now. If you're salaried, you've got incredible flexibility. You guys can just click your preference directly in the ITR every single year, bouncing between the old and new regime depending on your investments. But business owners and professionals, if you forget to file that Form 10 IEA, you are aggressively forced into the new regime by default, permanently losing all your traditional deductions for that year. It's brutal. Okay, moving on to another massive detail. For the NRIs watching, listen up because this is a harsh one-line reality check. You might have heard that income up to 12 lakh rupees is effectively tax-free now because of a $60,000 rebate, right? Well, NRIs are strictly excluded from claiming this resident tax rebate under Section 156, which we used to call Section 87A. So while a resident Indian earning 12 lakh pays absolute zero, an NRI earning that exact same amount in the new regime is going to be hit with a significant tax bill. So the big question, how do you actually decide between the two regimes? Honestly, you don't guess. You use a break-even matrix. We calculated the exact mathematical point where the old regime matches the new default one. Let's look at the 15 lakh mark. If you earn 15 lakh rupees, you need exactly $5,37,500 in eligible deductions, like your EDC, ADD, and home loan interest, for the old regime to make sense. Earning 24 lakh rupees, you'd need over 8.4 lakh in deductions. Wild, right? It all boils down to a super simple 2-line decision rule. As a baseline, if your total eligible deductions are sitting above 3.75 lakh, you generally want the old regime. If they're below that, stick to the new. For your exact income, compare your investments against those break-even numbers. If you beat your specific target, you must actively choose the old regime. And please do not forget that Form 10 IEA if you have business income. But if you fall short, just sit back, do nothing, and accept the new default regime. Look, this shift to the Income Tax Act 2025 is supposed to simplify things, but this transition period, you've got to be wide awake. Do not leave your wealth to guesswork, and please don't get caught off guard by the 2026 default switch. I want you fully prepared. DM me the word regime right now, and I will personally send you my free calculator so you can map out your exact financial path in literally 60 seconds. Calculate your break even, make your choice, and take control. So what's it going to be? Are you going to let the government choose your tax bill by default, or are you going to take control of your wealth today?